In the Forex market, one of the biggest challenges for any trader is making decisions based on solid information rather than assumptions. This is where the concept of confluence comes into play. Confluence refers to the combination of multiple factors, tools, or indicators that point in the same direction in the market. In essence, confluence is the practice of seeking additional confirmations before taking a trade, thereby increasing the likelihood of success. Confluence is built on a simple yet powerful principle. When multiple elements align to signal the same opportunity, the level of confidence in that decision increases. For instance, if a support level coincides with a reversal signal on a technical indicator like the RSI and is further supported by a candlestick pattern, this is considered strong confluence for a buy trade. Traders use confluence in many ways. One of the most common is combining technical analysis tools such as trend lines, Fibonacci retracements, moving averages, and support and resistance levels. Each tool offers a unique perspective, and when several align, the probability of the market moving in the expected direction is significantly higher. Confluence isn't limited to technical analysis alone. It can also incorporate fundamental factors such as economic news or monetary policies. For example, if an economic calendar highlights a high-impact event like an interest rate decision, and that event coincides with a technical setup, the confluence of fundamental and technical analysis can further strengthen the decision to trade. Why is trading with confluence important? Because it significantly reduces the risk of making impulsive decisions based on a single factor. Many beginner traders make the mistake of relying solely on one indicator or tool, leaving them vulnerable to false signals. Confluence acts as a filter, eliminating low-probability trades and focusing your attention on those with stronger backing. Another advantage of confluence is that it improves emotional management. When you take a trade based on multiple confirmations, you're more likely to trust your decision and less likely to close a position prematurely out of fear. This not only improves your results but also reinforces your discipline as a trader. However, it's essential to remember that confluence does not guarantee success. Even the strongest setups can fail due to the unpredictable nature of the market. This is why combining confluence with solid risk management is crucial. Using stop-loss orders and adhering to your risk limits are essential practices to protect your capital. In conclusion, trading with confluence is a powerful strategy that can make a significant difference in your results as a trader. By combining multiple tools and approaches, you increase your chances of success while minimizing the risks associated with single-factor signals. The next time you evaluate a trade, remember to look for confluences. Not only will you trade with more confidence, but you'll also trade with greater precision.